this time it's over. BMW and Mercedes-Benz go bankrupt in China. The Chinese stock market collapses immediately within minutes. The Chinese government is in panic and makes a shocking announcement. China is devoid of foreign brands. The downfall of BMW and Mercedes-Benz in China marks a pivotal moment in the economic relationship between foreign automotive giants and the Chinese market. For decades, China has been a critical hub for luxury car manufacturers like BMW and Mercedes-Benz, which capitalized on the country's growing middle class and their desire for premium, high-performance vehicles. However, the landscape has shifted drastically, and recent developments have pushed these giants to the brink of collapse in China. The roots of this crisis are multifaceted. On the one hand, China's retaliatory tariffs, enacted in response to trade tensions with the European Union, have crippled the competitiveness of European luxury cars in the Chinese market. BMW, for instance, has seen its sales plummet by 30% in the third quarter of 2024, marking the steepest decline in over 4 years. 33. Mercedes-Benz faces a similar fate, with significant losses across its luxury models, such as the C-Class, which had been a bestseller just a few years prior. These losses aren't merely reflective of a temporary downturn but are indicative of a deeper, more structural issue: China's shift in policy and market preferences. As China strengthens its domestic electric vehicle (EV) industry, led by companies like BYD, foreign manufacturers are being squeezed out. The rise of EVs in China has created a competitive environment that BMW and Mercedes-Benz have struggled to navigate. BYD's low-cost electric vehicles have garnered massive popularity among Chinese consumers, who are increasingly prioritizing sustainability and affordability over traditional luxury brands. 33. Moreover, government subsidies for domestic EV producers have made it even more difficult for foreign brands to maintain their foothold in this vast market. Compounding the problem is the Chinese government's focus on reducing dependency on foreign imports in the automotive sector. In response to sanctions from the EU regarding Chinese EV exports, China has raised import tariffs on European luxury cars to unsustainable levels. 33. This move has severely impacted the sales of BMW and Mercedes-Benz, which had relied on China as one of their largest and most profitable markets. The high tariffs have priced these luxury vehicles out of reach for many Chinese consumers, who are now opting for cheaper, domestically produced alternatives. The collapse of these two automotive giants in China represents more than just a shift in consumer preferences; it signals a broader economic transition within the country. China is aggressively pushing for technological self-sufficiency, particularly in industries like electric vehicles, where it aims to become a global leader. The government's support for domestic automakers and its increasing hostility towards foreign brands is a clear indication of this new direction. However, the fallout from BMW and Mercedes-Benz collapse will not be confined to the automotive industry alone. The loss of these major players in the Chinese market is a significant blow to China's international trade relations. As BMW and Mercedes-Benz struggle to find a path forward in China, the ripple effects will likely be felt in Europe, where these companies are cornerstones of the manufacturing economy. Thousands of jobs, both in China and abroad, are at risk, and the reputational damage to China as a business-friendly environment is already becoming apparent. For China, the departure of foreign brands like BMW and Mercedes-Benz is a double-edged sword. While the government's protectionist policies have successfully bolstered domestic production, the exodus of these iconic brands threatens to isolate China from global trade networks. The luxury car market, once a symbol of China's integration into the global economy, now reflects the growing economic nationalism that is taking hold in Beijing. On October 9, 2024, the Chinese stock market experienced one of its most catastrophic collapses in recent memory, a downward spiral that unfolded in a matter of minutes. The Shanghai Composite Index plunged by 6.62%, the Shenzhen Component Index dropped by a staggering 8.15%, and the Chinext Index for high-growth stocks tumbled by 10.59%. More than 854 companies faced trading halts, and over 3,000 stocks plummeted by more than 9%, leaving the market in disarray. The sell-off spread like wildfire, and within moments, panic overtook the trading floors, wiping out billions of dollars in market value. The rapid collapse was not a random event but the result of an accumulation of economic stressors that had been building for months. The sharp decline in stock prices was exacerbated by the growing instability in China's economic sectors. With foreign brands like BMW and Mercedes-Benz withdrawing from the Chinese market and domestic industries struggling to compete on the global stage, investor confidence had already been waning. The impact of trade sanctions, particularly in the automotive sector, triggered widespread uncertainty about the future of China's economy. This uncertainty was further compounded by internal economic pressures. As China pushed for greater economic independence, its aggressive policies toward foreign businesses, including retaliatory tariffs, worsened the situation. Major corporations and international investors, sensing a deteriorating economic environment, began pulling out their funds, leading to mass liquidations on the stock market. Despite government attempts to calm the markets with promises of economic stimulus and regulatory interventions, the damage had already been done. The collapse of the stock market wasn't limited to investor losses, it reverberated throughout the Chinese economy. In the wake of the crash, numerous companies found themselves on the brink of bankruptcy, and small investors, many of whom had entered the market during the speculative boom earlier in the year, were left financially devastated. Public outrage grew, and reports of financial ruin started circulating, adding to the mounting sense of panic. While Chinese authorities were quick to deny any direct correlation between the stock market collapse and these societal issues, the psychological impact was undeniable. Despite efforts by economic analysts to reassure the public, warning signs of deeper financial instability remain. Experts pointed to the over-reliance on government intervention in the stock market, cautioning that the reliance on short-term fixes such as bond issues and interest rate adjustments would not be enough to stabilize the economy in the long term. With such widespread losses, the crash is a stark reminder of the fragility of China's financial system, one that is heavily dependent on external factors and internal control. The shockwaves of China's economic turmoil did not stop at the stock market. In the aftermath of the collapse, the Chinese government scrambled to contain the fallout, issuing a series of emergency measures and unprecedented announcements that reflected the growing sense of panic among the nation's leadership. On October 10, 2024, officials made a startling declaration, the issuance of an additional 2 trillion yuan in special bonds to stabilize the market and inject much-needed liquidity into the economy. This desperate move underscored the magnitude of the crisis, as the government resorted to issuing more debt to salvage an economy on the brink of collapse. The announcement, however, was met with skepticism, both at home and abroad. While the government had hoped that this measure would instill confidence in the markets, many financial analysts warned that this was merely a band-aid solution to a much deeper problem. Years of aggressive state intervention, coupled with the increasing burden of corporate debt, had eroded the foundations of China's financial stability. The issuance of additional bonds only served to increase the country's debt load, raising concerns about long-term economic sustainability. At the heart of this panic lay the broader consequences of China's strained relationship with international markets. The trade war with the European Union and retaliatory tariffs had crippled key industries, particularly the automotive sector, where companies like BMW and Mercedes-Benz were forced to withdraw from China. These developments sent shockwaves through the economy, leading to mass layoffs and a growing sense of uncertainty among workers and businesses alike. The government's announcement of new stimulus measures came across as an attempt to buy time, but it did little to address the underlying issues of declining foreign investment and increasing isolation from global trade networks. Public reaction to the government's emergency measures reflected widespread distrust. Many citizens, still reeling from the losses they incurred during the stock market crash, viewed the bond issuance as a sign of deeper trouble to come. Speculation about the government's ability to manage the crisis only fueled further unease. Social media was awash with comments from citizens questioning the government's competence, with some comparing the situation to the economic turmoil of past decades. Despite reassurances from state media, the public remained unconvinced that the government could steer the economy back on track. The exodus of foreign brands from China has marked a dramatic shift in the country's economic landscape. Once seen as a lucrative market for global giants, China is now witnessing the withdrawal of major international companies, particularly in the automotive and luxury goods sectors. BMW and Mercedes-Benz, two of the most recognized foreign brands, are just the latest casualties in this growing trend. The reasons behind this departure are complex, but they point to an increasingly inhospitable environment for foreign firms, one shaped by both domestic policy changes and escalating international tensions. China's strategic push for self-reliance, especially in industries like electric vehicles, has created a competitive environment that has marginalized foreign companies. Government subsidies for domestic firms like BYD have allowed local brands to dominate the market, leaving foreign players struggling to compete. Moreover, the Chinese government's protectionist measures, including high tariffs on European luxury cars, have made it nearly impossible for brands like BMW and Mercedes-Benz to maintain profitability. These tariffs were a direct response to European sanctions on Chinese electric vehicles, creating a tit-for-tat situation that has further strained economic ties. The loss of foreign brands is not just a blow to the companies themselves but also signals a broader shift in China's economic strategy. For years, international companies flocked to China, drawn by its enormous consumer base and rapid economic growth. But as tensions between China and the West have escalated, the business environment has become more volatile. The Chinese government's emphasis on fostering homegrown industries, coupled with a cooling of diplomatic relations, has pushed many foreign firms to reconsider their presence in the country. What was once a thriving market for international luxury goods and high-end automobiles is now becoming increasingly dominated by domestic players. The implications of this shift are far-reaching. For one, the absence of foreign brands could impact China's global economic standing. While the country may be aiming for greater self-sufficiency, the departure of international companies could reduce its attractiveness as a destination for foreign investment. Multinational corporations, wary of the risks associated with doing business in China, may choose to invest elsewhere, further isolating the country from the global economy. For Chinese consumers, the departure of these brands also signals the loss of choice and quality, as many of the domestic alternatives still lag behind their foreign counterparts in terms of performance and prestige.